Being able to use the full range of strategies and instruments at a manager's disposal has allowed hedge funds to profit from volatility in commodity markets. And this has seen hedge fund managers making just as much money when commodity prices decline as they do when they rise. Here to tell us how these managers go about their business is Blue Ink's Tatenda Chapanduka. Thanks so much, Tatenda, for your time. So talk to us a little bit about the hedge fund industry in the commodities space and the direction right now that you're enjoying.
Okay, I think the hedge fund industry within the commodity space at the moment is still quite a small part or a small segment of the full hedge fund industry, but it is growing very well because of the strong performance, which especially locally, which the managers have managed to garner over the past couple of years. In terms of what we are seeing in the market at the moment, there are guys who have been playing relative value strategies within the Greeks market, trying to play arbitrage strategies between what's being traded maybe on CFX and what's being traded, maybe maize being traded on CFX versus corn which will be traded on Chicago or on New York Stock Exchange. So in terms of there being opportunities, there is a lot of opportunity that you are seeing, and in terms of the assets, it's still quite a small industry compared to the full range of the hedge fund space within South Africa. But we will see a lot of appetite and a lot of reason for it to grow further into the future.
Tatenda, obviously many South Africans think about commodity trading being very much around the hard metals, platinum, gold, perhaps some of the mining companies. Just give us a sense of the range and spectrum of activities within what you call the commodity space. I mean, are we talking about firms on one instance that are trading purely just perhaps hard metals, copper, gold, platinum, or are they kind of mixing them all together, trading a bit of corn and copper and agricultural products and mixing that with the other stuff, or is it very specialized in terms of these types of activities?
Okay, sure. I think what we have seen within this space, commodities is a very it's a commodity skill, or the skill to manage a commodity portfolio is a very specialized type of skill. So what we've seen is that guys tend to specialize within the market that they have enough experience to operate within. So one thing that you'd find is that some guys, because of maybe their background, maybe they traded at Cargill or maybe Tiger Brands, they will trade a specific market. So you find that maybe some guys will trade just the soft commodities, and some guys will trade just the metals. And also that kind of leads into also the specialism which exists between the strategies themselves. You also find that guys who play relative value strategies would tend to specialize within those relative value strategies, and guys who play directional strategies and manage futures would tend to specialize within those strategies.
Just in terms of the ability to trade commodities, I mean, obviously we've got a very well developed agricultural sector in South Africa. There's plenty of corn and things to trade on SAFEX. Just give us a sense of what are the guys trading when we move towards metals and mining and the hard commodities? Are they actually trading in physical overseas, or are they trading that locally, or are they using financial instruments to trade those in those markets?
Okay. So, in terms of the fund that we have, or the managers that we have locally, those guys trade just within the liquid markets. They trade futures. They will trade options. They will trade swaps. So in terms of the strategies that we will invest into, or the strategies that we are seeing, it's guys who are trading on liquid markets across the world. Not much of guys trading the actual physical commodities. But I think once you start going offshore, you also do get guys who play who play within the physicals, because there is also arbitrage which can exist between, say, the spot market and the futures market, and maybe you might need to implement maybe a cash and carry arbitrage strategy
Tatenda, earlier you spoke of
to extract alpha. But
Tatenda, earlier you spoke of a very specific skill needed to trade commodities in the hedge fund space, and that obviously speaks to the volatile nature of the underlying commodity. High risk, obviously high risk yields a high reward, but you obviously have to have appetite for that risk to be in this space.
That's true, Bronin. I think when you look at commodities, or an investor who should be comfortable with the risk which comes with commodities, is somebody who would maybe who is willing to invest into equities. Because if you look at the risk or the return distribution of commodities, it's almost equity-like, and therefore commodities do come with some volatility, and I think now once you start moving into the hedge fund space, and you can go long and you can go short, and you can also implement some relatively low risk strategies, you can act to dampen your volatility. And for somebody who is not very comfortable with a lot of volatility in their portfolio, they can now come and invest into a fund of, say, into a commodity fund of hedge funds, because the commodity fund of hedge funds aims to bring together uncorrelated strategies within the commodity space and create a new product which has a better risk return payoff profile.
Tatenda, just to ask you, I mean, and I think obviously it talks to the risk. Do the guys use the same amount of leverage in trading these commodities as they do in perhaps equities or fixed income?
Okay. The guys will use much more leverage than equities, but much more in line with what the fixed income managers will use. I think when you come sorry, when you come and you look at commodities, you have to look at it in a very different way to how you look at maybe equity risk. It's not really the leverage that you have to worry about, but it is say the margin to cash ratio, because it kind of like, it gives you a better feel of what risk you are actually running within a portfolio. So in terms of leverage, because they trade mostly derivatives, commodity managers will use much more leverage than equity managers. But I don't think leverage by itself indicates how much risk is being run within a portfolio.
Tatenda, great chatting to you. Thank you so much for your time. Tatenda Chapanduka, research analyst at Blue Ink Investments.